Welcome to Money and Markets, Series 1, Lesson 2. This episode is called Compound Interest, the Eighth Wonder of the World. In Lesson 1, you met the time value of money. $1 today is not the same as $1 next year. Here, we zoom in on the mechanism that makes that gap explosive instead of polite. Interest that earns interest. We will revisit future value intuition. Use the snowball metaphor so your gut matches the algebra. Hear three famous voices on the same theme. Run the headline retirement number from the classic article, about $3,096,000. And walk 10 plain language reasons the idea matters in real portfolios. Then we pivot to the yield curve, a normal upward slope versus an inverted shape, and what journalists are trying to signal when they write those words. Here is the map of this episode so you know where we are going. First, simple versus compound interest and a tight future value recap. Second, the snowball metaphor and the rule of 72 for doubling time. Third, three famous voices on the same idea: Einstein, Buffett, and Franklin. Fourth, the headline retirement thought experiment. $70,000 a year, save 10% from 25 to 65, and the number everyone quotes, about $3,096,377. Fifth, 10 plain language reasons compounding matters in real life across 2 beats on screen. Sixth, the yield curve, normal versus inverted so finance headlines stop sounding like noise. Seventh, a short bridge to Lesson 3 on inflation and real purchasing power. Let us begin. Let me start with the emotional truth behind the formulas. Because math anxiety is usually story anxiety in disguise. Simple interest pays you only on the principal you started with. Compound interest pays you on the principal and on every dollar of profit you have already reinvested. That difference sounds like a tiny footnote. In real decades, it is the difference between a straight line and a curve that bends upward. If you have ever felt that wealth builds slowly at first and then surprisingly fast, you were feeling compounding. If you have ever watched a credit card balance refuse to die, even when you pay a lot, you were also feeling compounding. Same math, opposite sign. This episode is about naming the curve, respecting it when it works for you, and fearing it when it works against you. We are not selling a get-rich-quick fantasy. We are building the vocabulary you need before anyone shows you a spreadsheet. Quick recap from Lesson 1 so we stand on the same rock. Present value answers: what is a future cash flow worth today if I discount at a rate that reflects risk and time? Future value answers the mirror question: where does today's cash land if I roll it forward at a stated return? In the compound world, each period you multiply by 1 plus the rate on the entire balance, not just the original stake. That is why the same annual percentage can produce wildly different outcomes, depending on whether interest is withdrawn or reinvested. Once you see future value as repeated multiplication instead of a one-time addition story, every yield chart in finance starts to look familiar. Keep that picture in your head as we add stories and market structure on top. Picture a snowball rolling downhill. At first, it is awkward and small. Gravity and stickiness barely help. Then it picks up mass, and the new surface area helps it grab even more snow on the next rotation. Compounding is that feedback loop translated into money. Early dollars are psychologically hard because the balance still looks boring on your phone screen. Later, the same savings rate feels easier because the balance itself does more work each year. Not because you became a genius, but because the process is multiplicative. This is not a moral sermon about virtue. It is arithmetic with a patience requirement. The practical lesson is simple to say and hard to live. Do not abandon the plan in the flat part of the curve, right before the bend. Most households lose to behavior, not to ignorance of the symbol R in the formula. Here is a mental shortcut that travels well at dinner parties. The rule of 72. Divide 72 by your percent return, to approximate how many years it takes money to double. 6% implies about 12 years per doubling. 8% implies about 9. 9% implies about 8. The shortcut is not exact to the day. Bond coupons and stock paths are messier than a textbook. The point is intuition. Small changes in the rate change the doubling clock more than linear thinking expects. And 2 doublings is 4 times, not 2. When someone says an extra percent does not matter, remember the doubling schedule. When someone promises heroic returns with no risk, remember that the shortcut assumes you actually earn the rate. The hardest assumption in real markets. Albert Einstein is often quoted as calling compound interest the most powerful force in the universe. Historians argue about whether he said it exactly that way. And quote, archaeology is not the point. The line survives because it matches lived experience. When returns are positive and reinvested, balances accelerate in a way that feels like physics. You can treat the Einstein attribution as folklore with a sharp moral. Respect the exponent. A bad year hurts. A skipped decade hurts more. The universe of finance is full of slogans. This one happens to be a decent reminder that time and reinvestment are not decorative assumptions. They are the engine. Warren Buffett puts it in plain English. His wealth came from living in America, some lucky genes, and compound interest. Notice what is not on the list. Day trading bravado, secret indicators, or a guarantee that you can copy him tick for tick. Berkshire's history is decades of reasonable returns, applied to a growing capital base, with frictions and taxes managed carefully, and with catastrophic mistakes avoided more often than not. You may not run a holding company. You still live inside the same arithmetic. Buffett is asking you to take compounding seriously as a lifetime posture. Start early. Stay solvent. Avoid unnecessary fees. And let the curve do the boring heavy lifting while you focus on skills, health, and family. Benjamin Franklin said, "Money makes money, and the money that money makes money." Read that twice. It is a one-sentence lesson in reinvestment. Franklin was not handing you a lottery ticket. He was describing a generative loop. When dividends buy more shares, when interest buys more principal, when a business retains earnings and redeploys them into productive projects. You are watching Franklin's sentence in the wild. The opposite loop also exists. Unpaid interest capitalizes into debt, and the debt grows its own interest bill. Same machinery, different sign. If you remember only one thing from this trio of quotes, remember reinvestment as a fork in the road that appears constantly in adult life. Now the headline illustration, adapted from a classic personal finance article that circulates whenever someone wants to wake up a young professional. Imagine you earn $70,000 a year, a round middle-classish number in many cities, and you save 10% of it starting at age 25. That is $7,000 a year going into diversified investments instead of lifestyle creep. Assume a long-run average return in the neighborhood of 10% on a diversified portfolio. Reality will not hand you a smooth 10 every year. Crashes, job loss, fees, and taxes all exist. We are isolating the mechanism, not writing a bank guarantee. The goal is to see how 40 years of disciplined contributions interact with an exponent when nothing heroic happens beyond consistency and patience. Under those steady assumptions, the ballpark terminal number people quote from the article is about $3,096,377 by retirement. Say the commas out loud on purpose. 3,096,377. Because rounding to about 3 million hides how sensitive the path is to small changes in return, fees, and start date. This is not a promise about your life. Markets wiggle. Careers wiggle. Health wiggles. And 10% was a teaching assumption, not a contract. The emotional job of the counter is to shock you gently into starting now, not into arrogance. Humility plus compounding beats swagger without savings in most decades. If the number feels unreal, good. That is the point. The math is trying to train your intuition for exponentials before a salesperson trains it for you. Here are the first 5 of 10 reasons the article format works so well for teaching compounding without drowning beginners in notation. First, growth is exponential, not linear. Your brain wants straight lines. Markets give curves, and household wealth does too. Second, time in the market multiplies small edges. You are hunting repeated rolls of a modestly biased die, not one heroic spin. Third, reinvesting interest earns interest on interest. That is the literal definition we keep repeating, because repetition builds intuition faster than a single clever proof. Fourth, starting early beats chasing heroic returns late. Months inside the exponent often beat chasing an extra 0.5% in your 20s. Fifth, consistency beats perfect timing. Most households win with boring systems, automatic transfers, and fewer trades, not with crystal balls. If these sound like character virtues dressed as finance, that is because adult money is half math and half behavior. 5 more reasons, this time with warnings attached, so the story does not turn into toxic positivity. Cash sleeping in a drawer loses to inflation over long horizons. Compounding is the mathematical vocabulary for why idle cash has a cost, even when it feels safe emotionally. Debt compounds against you. Credit cards are the same machinery, with a minus sign in front of the rate, which is why minimum payments trap people in a spiral that feels morally unfair, but is arithmetically fair to the lender. Tax-advantaged accounts can amplify returns when the rules fit your jurisdiction in life. Learn the rules instead of guessing from headlines. Diversification still matters. You want compounding on a broad basket, not lottery concentration dressed up as confidence. And finally, patience is behavioral alpha. The equation only works if you stay in the seat when the world gets loud. Courage is not ignoring risk. Courage is sticking to a plan you understood when you were calm. Pivot to bond markets for the yield curve, the bridge between interest rates on savings accounts and the macro news ticker. Think of a yield as the annualized compensation lenders demand to part with money for a chosen maturity. A normal curve slopes upward. 3-month government paper usually pays less than 10-year or 30-year bonds. Why? Time is risky. More calendar pages mean more chances for inflation surprises, policy changes, and borrower stress. So lenders want extra compensation to lock money away. When you see a gentle upward staircase on television, that is the default textbook healthy baseline. Not a guarantee of prosperity, but a common shape when markets expect growth and moderate inflation. We are building vocabulary so Lesson 3's inflation story lands cleanly. Sometimes the staircase flips. Short yields higher than long yields. Journalists call that an inverted yield curve. And traders obsess because it has preceded several famous recessions. The statistical history is real. The crystal ball temptation is dangerous. An inversion often shows up when markets price slower growth, easier policy ahead, or flight to safety demand for long bonds. Different mixes at different times. Treat it as a warning shape, not destiny. Households should still avoid panic selling a coherent plan because of one chart. The useful skill is translation. When someone screams inverted curve at you, you should hear, markets are willing to accept low long yields relative to cash-like rates, and ask, what story does that embed about expected cuts or stress? That translation skill is part of financial literacy in a media-heavy world. You now have the emotional stories, the headline retirement illustration with the precise comma placement, 10 structured reasons split across 2 beats, and the yield curve vocabulary in normal versus inverted form. Next lesson, we connect nominal interest rates to inflation and real purchasing power, the Fisher intuition, and use the Big Mac Index as a playful map for why the same $5 buys different burgers around the world. If compounding is the engine that builds wealth when it works for you, inflation is the hill you roll against when prices rise faster than your savings rate. Bring a skeptical mind and a notebook. I will see you in Lesson 3.